Today, on the Dapper Dividends YouTube channel, we're talking about something important in the world of ETFs. It's how they can disappear just as quickly as they appear. Do any of you remember my video about Roundhill's Dividend Monarchs ETF, ticker KNGS, that I made less than 2 years ago? Well, the Dividend Kings ETF is gone, lasting barely a year on the market. As Warren Buffett said at the 2013 shareholder meeting, quote, "Anything that Wall Street can sell, it will sell." And if you haven't guessed, my name is Russ, and I have a free and fantabulous weekly newsletter that you can sign up for at DapperDividends.com or using the link in the description below, where I share some investing thoughts, all the portfolio moves from the week that was, and some stocks about to go ex-dividend. And for the quickest affiliate plug ever, if you would like to save a bunch of money on an annual Seeking Alpha subscription, use my affiliate link below. And I think we're seeing this play out again with Roundhill's latest offerings. But I want to recap what the KNGS, the Dividend Monarchs ETF, was supposed to be. It tracked the S&P Dividend Monarchs Index, which included companies that had increased their dividends for at least 50 consecutive years. These are the elite dividend kings of the market, and in that previous video, I pointed out two concerns. My thought and opinion is that many of these kings, they don't have a very high yield, and they're really just token increasing that dividend to keep their dividend streak alive. So there's likely going to be a higher weighting toward companies like Leggett & Platt and 3M to make the fund attractive to investors, especially those who are passionate about passive income, which that could be risky in the event that some of the higher yielding kings cut their dividend and are booted from the index. Then the yield would likely suffer. And what happened? Two kings lost their crown. Leggett & Platt and 3M are companies that had to cut their dividends shortly after, which is exactly one of the things I was worried about. Not only is Kings gone, but their digital infrastructure ETF BYTE, which is another Roundhill ETF I mentioned in that video, has also been liquidated, as well as an inverse Mag 7 ETF, which would move in price opposite to the Mag 7, has also been liquidated, which is just a really important reminder that ETFs can and do disappear. Now, when an ETF is liquidated, investors receive their shares' net asset value. So you likely won't lose much, if any, money from the liquidation itself, but you might face unwanted tax consequences from the forced sale, transaction costs to reinvest elsewhere, and lost time and research. So here we are at roundhillinvestments.com, and if we look at all of their ETFs, we'll see that they have quite a few. They have fun tickers, like I said in the last video. The Magnificent 7 ETF did win an award, so that one looks pretty good. It's just a simple way to just get exposure to the Mag 7 stocks in one ETF. But as we scroll down to the bottom, it's some of these newer ones that I'm concerned about, and I think you should know about too before investing, which are things like the Palantir WeeklyPay ETF, the Nvidia WeeklyPay ETF, Tesla, Coinbase, and Apple. Now, I find it interesting because stocks like Palantir, Tesla, and Coinbase do not pay dividends. So how are you getting weekly dividends from these ETFs? Now, they tell us that their weekly distributions, which is a nice recurring income stream for shareholders, they have enhanced exposure. They amplify returns by targeting 120% of their reference stocks' weekly performance. And they give you a potentially powerful combination of single stock leverage and weekly income. Now, I want to highlight what they actually do, and this comes from the prospectus. First is that WeeklyPay ETFs seek to amplify returns by targeting 120% of their reference stocks' weekly performance, which means that WeeklyPay ETFs try to give you 20% bigger returns than regular stocks each week by using special financial tools. So when a stock goes up or down, these movements make that 20% stronger, which also means that both potential profits and losses are also magnified. Second, it says each fund's strategy is subject to all potential losses of the tracked stock. If the tracked stock shares decrease in value, the fund may lose all of its value if shares of the tracked stock decrease by 83.33% over the course of any calendar week. Did you catch that? I mean, it's highly unlikely, but it's theoretically probable, right, that if any of the reference stocks drop by 83.33% in a calendar week, you could lose all of your investment. And then this one's really important, where it said the fund currently expects to make distributions on a weekly basis. Such frequent distributions may expose investors to increased tax liabilities. However, these distributions may exceed the fund's income and gains for the fund's taxable year. Distributions in excess of the fund's current and accumulated earnings and profits will be treated as a return of capital. So here's the thing about those weekly dividends that I think you should understand, is that they are distributions and they are fundamentally different from traditional dividends because they don't come from earnings or profits of the reference companies like Tesla or Palantir, which don't pay a dividend. They could primarily be a return of capital, which is really just giving investors their own money back. They are engineered financial products using derivatives like swap agreements, and the amount will fluctuate weekly based on market conditions. The prospectus is careful not to call them dividends, but instead refers to them as distributions or weekly distribution payments, which is more accurate given their nature. Now, these funds also have a whopping 0.99% expense ratio, which means for every $10,000 you hypothetically invest, Roundhill takes about $99 per year. And if these ETFs can attract enough assets, Roundhill will make money regardless of how the ETFs perform. So the story of the Dividend Monarchs ETF, ticker KNGS, and these new WeeklyPay ETFs, I think, highlights a really interesting pattern in the ETF world, which is to create ETFs that capitalize on current investor interests, collect fees as long as money flows in, and then close them down when interest fades. Remember, just because an ETF exists doesn't mean it's a good investment. These WeeklyPay ETFs have only been around since February of 2025. The weekly reset of leverage can lead to very different performances than some of the ETFs that have daily leverage reset. And Roundhill mentions that these ETFs are explicitly marketed as only suitable for knowledgeable investors who actively monitor their investments. And as the common market wisdom goes, you always have to understand what's under the hood. When you buy an ETF, any ETF, you are buying the methodology that selects what goes in it or how it pays out its distributions. So I think that these WeeklyPay ETFs are really just leveraged bets on individual stocks that are in an income wrapper and are designed to attract yield-hungry investors. But what do you think? Are these legit, or could these ETFs be the next to join the Dividend Monarchs ETF someday soon in the Roundhill ETF graveyard? Let us know in the comments below. And in this floating little box right there next to my head, I share 6 safe and cheap dividend stocks to put on your radar. So if you click that floating little box next to my head, I will see you there.